Periodic portfolio rebalancing is a financial advisor standard and is heavily endorsed by major financial institutions. And I don't do it. I don't rebalance my portfolio. At least I don't rebalance it in the same way most investors do. And I think the traditional advice to rebalance on a schedule or just because of meager price appreciation is teaching investors to sell exactly what they should be holding. If a company I own has strong fundamentals and the price has doubled because the market suddenly recognized its value, why would I automatically sell it? Simply because it now represents an overly large percentage of my portfolio. So the distillation is this. I don't rebalance by selling. I rebalance with new money. So if all you wanted were the basics, there you go. But if you want the details, keep watching. Traditional rebalancing has its place, and it's not a bad thing, not at all. Even my favorite ETF, SCHD, rebalances on a schedule, but that's part of its structure. And there are legitimate reasons to sell for rebalancing. Thesis misalignment, tax loss harvesting, valuation becoming disconnected from fundamentals, deteriorating business, emergency situation, or a once-in-a-lifetime opportunity that they come about once in a lifetime, but you need to be ready for them. A changed risk tolerance, an allocation becoming so distorted that contributions can't reasonably correct it. So I'm not advocating against traditional rebalancing in all cases. What I'm advocating against is mandatory, calendar-based rebalancing as a rule. For some investors, at least the ones who think like I do, it may be an inferior way to manage fundamentally strong assets. As I've mentioned before, much of what I advocate is for investors, not traders. My approach caters to the long-term investor who has at least some capital continually flowing into the portfolio and doesn't want to interrupt a fundamentally sound compounding asset merely to satisfy either an arbitrary allocation percentage or even a self-imposed allocation percentage. So here I say, don't rebalance the portfolio by selling your winners. Rebalance the portfolio by directing new capital towards whatever has become underweight. The core idea is this. Traditional rebalancing says something like, my allocation changed, therefore, I need to sell something. My approach says, the allocation changed, therefore, I'm going to change where my next dollar goes. But my existing dollars, they're going to stay right where they are. I'm not going to sell anything. Don't sell, fool. If we start with a $10,000 portfolio where all of the holdings have equal shares of 25% each, and over time, holding A increases in value to 35% of the portfolio, the traditional approach says sell $1,000 of A, then redistribute it to the other members of that portfolio. My approach says sell $0 of A and then redistribute new dividends and or income and or other contributions. For example, for the next $1,000 contribution, $100 can go to A, $200 to B, $350 to C, and $350 to D. Now, the portfolio still moves towards its target without liquidating the winner. And even the winner still gets to wet its beak. That's a Sopranos thing. I can't remember which episode, but
I don't stick my beak in.
Tu c'è dire amici tuoi, chi non voglia sei, tanto per vagliare mia bocca.
some of my arguments for this approach is that you're not forced to sell a good asset just because the calendar says so. Suppose you establish a 25% SCHD, 25% SCHG, 15% IQLT, a 10% V Visa, 10% MSFT Microsoft, and a 5% IBIT. Microsoft then has an enormous run and becomes 15%. Traditional rebalancing says sell 5% of Microsoft and redistribute it. My philosophy says, why? Is Microsoft suddenly a worse investment because it appreciated? If the thesis remains intact, the fundamentals remain strong, and The price exists within a healthy range of the mean.
Watch your tone, sucker.
You leave it alone. Your future contributions then disproportionately can go towards the other holdings, at least until the portfolio moves back towards the desired allocation.
Post-production edition. Note that portfolio imbalance may be caused by other assets dropping in value rather than the overweight asset increasing in value. Regardless of the imbalance trigger, it is most logical to evaluate portfolio holdings for thesis alignment and fundamentals quality, and let that result guide rebalancing activity.
This process has a longer time horizon than traditional rebalancing in regards to implementation and resolution, but that's essentially rebalancing without liquidation. And another point is you're preserving the existing compounding engine. The compounding conversation is one of my faves, with the Charlie Munger, Jack Bogle tandem mantra always being front and center. Never unnecessarily interrupt compounding, and don't just do something, stand there. I really like that one. It's like Alice in Wonderland, something like that.
What are you doing out here? Don't just do something, stand there.
Selling creates a discontinuity. Asset goes to cash extraction, goes to different assets cash injection. My approach is asset keeps compounding while new money goes to underweight asset. I'm attempting to correct the portfolio's future trajectory without interrupting the compounding of the existing capital. I'm not saying selling necessarily interrupts all compounding, as structurally, the money can continue compounding after being redeployed into new assets. However, selling does interrupt the compounding of the original asset, even if the ability to compound is transferred to a new asset. And selling may also create transaction and tax consequences, and perhaps even a touch of mental anguish. And it forces you to make additional timing decisions that simply aren't necessary when new capital is available. And then my final point here, dividends become a natural rebalancing mechanism. I find this a particularly elegant approach for any portfolio. Instead of ARK pays a dividend that gets reinvested into ARK, you can have ARK pays a dividend that gets carved up and a large portion gets redirected towards whichever holdings are currently most underweight. But not all of it. Not all of that money goes to new stuff. ARK generated that money, so it gets to keep part of that money. Remember that wet the beak thing? But you get to decide what that kept percentage is. You haven't sold anything. You've simply redirected the portfolio's incoming cash flow. And if you're also adding outside income, you have two rebalancing income streams, dividends and new contributions. They can go to underweight positions and reinforcement of the overweight position. Overweight still gets the taste. Now, there is a hiccup. There's a requirement in order for all of this to work. You've got to have some ongoing cash flow from somewhere, anywhere. That's the vulnerability. You need to have income, dividends, or some other money coming in. This is why for any portfolio, I advocate for growers, showers, and blowers. Get your mind out the gutter. I know what you're thinking. Growers. These are stocks that have high growth potential with rapid price appreciation. They're growing. These allow you to take advantage of hot sectors and market trends. Showers. These are stable stocks that add resilience and stability to the portfolio. They are proven commodities that have already shown what they're about. This allows you to better survive black swan events and downturns. And blowers. These are stocks that are risky, speculative, and maybe even akin to gambling. You could easily blow all of your money on these. These stocks allow you to stay abreast of bleeding edge technology and trends while providing an opportunity to win the big board lottery if you're lucky and pick the right stock. Dividend payers operating as a significant portion of the portfolio are essential for me. I like dividend payers, but I especially like monthly dividend payers. They perform the role of consistent income generator and act as a capital injection metronome for when I don't supply outside income. Eventually, the dividend payers will grow to where I don't need any outside income at all. But I'm not there yet. But man, I can't wait. I really enjoy thinking about it. Imagine someone with $1 million who's retired and withdrawing $50,000 annually. Depending on their circumstances, they might not be able to carve off any of that $50,000 to act as new money to rebalance with. This means that this strategy is much less effective if the portfolio also doesn't have intrinsic income generation. Or suppose an investor has a $500,000 portfolio and $5,000 a year in new contributions. But then an asset becomes massively overweight. In this case, they may need years to correct the allocation through contributions alone. But the key word here is massive. There's this concept of not rebalancing unnecessarily, and then there's the concept of ignoring a particularly massive price appreciation event that screams to trim the position. There's a point where massive becomes too massive. You decide what that number is for you. Trim when it makes sense though, but not on a hard schedule. Let the portfolio tell you when to rebalance, not the calendar. This isn't a universal replacement for rebalancing. It's a strategy for investors who have sufficient ongoing capital or portfolio cash flow to redirect. So the distinction here is, I wouldn't call my philosophy never employ traditional rebalancing mechanisms. Instead, I'd call it don't rebalance mechanically. If you've already identified the circumstances in which you'd sell, extreme valuation, fundamental deterioration, investment thesis changes, potentially an extreme market cycle, tax implications, or an emergency situation, that's not a buy and hold no matter what mandate. It's a hold unless there's a reason to stop holding assertion. Don't just do something, stand there. All of that is a protocol, a system with explicit thresholds, triggers, and actions that represent a sophisticated philosophy. The big idea is to rebalance your thought process, approach, and plan behavior before you rebalance your portfolio. Instead of changing what you already own, change where you put the next dollar. The broader principle becomes capital allocation is a flexible, continuous process, not an annual event. Now you're allowing your existing holdings to appreciate, and you're using new money to correct relative weightings. You're not simply selling one great asset to buy another. Good luck on your portfolio management journey, and thanks for watching.